why they're buying those locations. Makes a lot of sense because these areas are going to do demand outstripping supply. It's happening. Everyone is running as fast as they can into that area.
Demand's actually jumped up again.
Run. Property investing in 2024 has changed. The rise of data-driven buyers agents and data-driven property investors is a fairly new concept. It was not like this in 2015, 2016, all the way to 2020. This is a fairly new change, and the sheer scale and size of these type of property investors has exploded. So too has the buyer's agents scene in Australia. Today, we have a dozen odd big scale buyer's agents buying 10, 20, 30, 40, 50, and even some closer to 100 properties every single month. This industry has elevated property investing in Australia dramatically. People are making better decisions, buying better quality property investments, and they are educating Australians about how to do buy and hold property investing better and better. But the big change also is a structural shift to the way property investors are purchasing property in Australia, and it gives rise to an alternative opportunity. If everyone is using these buyer's agents and using these same strategies and following the same data to do it, that is all publicly available, and buying similar type of properties, and now so many Australians are doing exactly the same thing, that means that there is increased demand, a dramatic increase in demand in these locations that these buyer's agents are targeting based on the data. And the data itself can skew in some locations. In this episode, a little bit of a controversial one, we're going to talk about how big this problem is, how big the size of the industry is, what areas buyer's agents are buying in, what areas those with data-driven property strategies are looking at today and have looked at in the past, and some of the risks associated with it. Towards the end of the episode, we're going to come up with a checklist to be someone who leads the way in this change. Someone who acknowledges this is the new marketplace property investors operate in. It is a national marketplace. It is a marketplace full of other people following each other. How do you be one step ahead of everyone else and do something a little bit different? What checklist do you need to come up with that looks a bit different to your peers, or even takes advantage of the very fact that many people are simply following each other? Curtis, what do you think?
Yeah, this is one I think we've definitely noticed change a lot. You know, in 10 years working with property investors, sorting out the finance side of things,
Sure.
The conversations that we have with investors maybe 10 years ago where people are like, cool, I am familiar with the area that I live. That's where I want to invest. Or, hey, I've lived in some other places. I've got some exposure to XYZ location, and I'm interested in that as an investment area, compared to today where, you know, it's a lot more data-driven. People are investing in places that they've never even set a foot on the ground. They're like, hey, I've, you know, run the numbers and I have access to some tools that's telling me that this is the right area to buy. And that's what I'm basing my investment decision off. It's been, I would say, like a very, very marked shift in the way people approach it, which kind of leads to this topic about like what the risks and what the opportunities of that are.
Yeah, it's a great little summary that you've just put in place there. I think I should just acknowledge, and I did at the beginning, that this approach and this strategy is really good. It's buy and hold property investing. So this is what buyers agents are buying. They are, and data-driven property investors. So the big buyers agents, you know, I'm not going to name any, but just the big ones you would have all seen, or just Google and you'll see them all pop up. The ones doing most of the transactions, all the award winners, all of those sort of groups of people, they would have some sort of data spin on their websites. That's kind of what they're looking at. And even if they don't, they're following information to help them purchase in these locations. So they are buying based on areas where demand is outstripping supply.
Yep.
And they're using metrics to do that, data metrics like vendor discounting, days on market, total sales listings, vacancy rates, rental growth, previous price growth history, percentage of owner occupiers purchasing. They're using a whole ream of data available there, but really what they're looking for is areas where demand outstrips supply. Pretty easy to actually do, not very hard. You can just go on DSR ratio tools or higher than average growth analysis. You can go on all these data metric tools and it'll do all the work for you and give you a suburb list. They're basically using that and marketing and explaining and educating the ideas behind why they're buying those locations. Makes a lot of sense because these areas are going to do well. Demand outstripping supply, gonna do well. They're looking for change, they are buying it. They're also buying existing dwellings with good rental yields. They typically rule out yields below 4.5%, often want 5% plus. So they're buying good rental yields. They're buying old homes with good rental yields, ideally on decent sized land content in data-driven areas. So that's what they're buying. And now, how many are they buying? So I've done a little bit of homework to this to, understand it a little bit more. Some of these buyers agents, they buy 50 properties a month. And let's just say there's 6 of them that buy with this data-driven strategy. That's 300. And then there's another 12 mid-sized sort of companies that are buying about half of that sort of size. That's another 300. And then there's a whole group of smaller, much, much smaller operators, a little bit like mortgage brokers, so many out there now operating the same strategy. Let's just say they all amount to, a couple of these larger ones when you congregate them all up. So you're getting to, 500-600 purchases, maybe even 1,000 if you want to extrapolate it out a bit further, but between 500 and 1,000 purchases every single month from this industry, all following data-driven areas. Now, they don't buy in 20 different locations. At a particular point in time, they're buying in 5 locations. They all say 10, but 80 to 90% of their transactions will be in 5 locations. Makes sense. They're focusing on one area. They've developed relationships in one area. That's kind of where
if they're data-driven, it'll be the ones that are, near the top of the list. Yeah.
Exactly. Yeah. They're not going to go to the bottom of the list or the middle part of the list. So, they have 5 different strategies, 5 different locations. The bigger ones will have 5. The smaller ones might only pick 1 or 2. It's what they know. I know this because I invest individually in a few individual opportunities in a few different locations. I'm not an expert of so many different areas. So a lot of these buyers agents will be buying in these sort of areas. Now, it's not only buyers agents, it's all the people who are, purchasing courses and understanding their data-driven approaches. They're all buying in similar type of locations. They might be a little bit more expansive because they will be aware of this problem a little bit. But they the scale here, we're talking 1,000 property purchases and, 20% of them could be in one certain area every month. That could be 200 property investors congregating into one area in a single month. Not really a big deal in Sydney. Not really a big deal in Melbourne. But what happens when it's in Townsville? Does it get a bit funny there where 200 people just rock up overnight being like, oh, can I buy a property here, everyone? It gets a bit funny when you start looking at these smaller areas, doesn't it? Yeah,
this is where it gets interesting. Is like you say, in a really, really big market, that kind of level of activity might not really move the needle in of itself, right? A little bit of an uptick in demand, but whatever. But like you say, if you congregate it all in a smaller market, just less property available, right?
Yep.
You can get into a situation where the increase, I kind of term it as a bit of a self-fulfilling prophecy, right? Where the increase in demand that's coming from investors through these buyers agents or investors doing it themselves through these data-driven tools, adding such an increase in demand for these properties that pushes the price up in of itself, which then reflects when the sales go through or hits the data metrics, reflects in the DSR tools, right? So they're going, hey, demand's actually jumped up again, which is a result of people using the DSR tools in the first place to find these suburbs. And you can get yourself in a little bit of a cycle where the investment activity starts to be the thing that's driving the supply and demand imbalance more so than the original underlying supply and demand imbalance that was there to start with.
Yes, exactly. Some of this is protected. So these people are smart people, they're run by some of the people I respect the most in the industry, exceptionally talented people individually. And some of the protections here are they would be looking at vacancy rates. So technically, if you have so many investors go in and buy in a certain area, the vacancy rate should pop up because investors are adding in rental supply.
Yeah, to a market that maybe can't absorb it or doesn't need it. Yeah.
Exactly, right? So that's one thing that they'd be looking at. The second thing that they'd be looking at is the renter and owner-occupier proportion of demand.
Yep.
So they would be ruling out owner-occupier areas that have too many investor profile areas. And then there's the third bit. This is another little tool, data metric or filtering criteria that many of these people would have is recent price growth. If an area is up more than 50% in 2-3 years, or 60% or 30%, pick a number. Like if it's just shot up recently, most of these experts would be ruling the area out, being like, look, it's had its growth cycle. Sure, the data's still good, but it's had its growth cycle and I don't know what I don't know and I don't know when it could end. So let's put it in the too risky basket now, even though recent price growth has been so strong. Let's put that in a risk factor, not a pro factor.
Yes.
So there are a few metrics and tools used to protect yourself against this. But here's the thing. These are the same tools that everyone else has. These are the same protections that everyone else has. So it still goes back to the same problem. If you have 200 people that go to a small little area and go up, buy up all the homes that the locals can't buy homes and prices start going up a bit, doesn't it mean that people are all following each other and buying the same product and now you're competing with each other to buy this product and you might be overpaying and you might be buying these off market and using recent comparables, but those recent comparables are the buyer's agent's clients from last month and then the month before, if that makes sense. So does that not create a little bit of an issue where performance benchmarks for success are driven by their own demand?
Yes.
That makes sense.
Yeah, it does. But I think your way to manage this is basically where in the growth journey you're jumping in, basically. Because if you are the world's best investor and you manage to time it just before like any growth kicks off, right? And you're a genius, then your protection is that even if there is some self-fulfilling price growth, if you're in early enough in the cycle, that's probably not a massive concern for you because you're like, all right, I've already got my exposure here. If a whole bunch of investors are generating a lot of demand and that's pushing the price up, I'm already locked in. So like I'm okay. So I think that last metric you mentioned about, okay, how much price growth has there been in the recent history becomes something that's a critical risk consideration, which under other investing strategies that are less data-driven maybe wasn't something that was as forefront in people's minds.
Yes. So this all becomes so interesting. Understanding how this huge property investor demand, a new investor demand, has come through is a change in the marketplace. So understanding what they're looking for, understanding why they're looking there, and some of the factors that they use as control mechanisms can help you be one step a little bit ahead of the game here. Some of the things that I take out from this, and this probably seems a little bit unfair because we're mortgage brokers, and we're probably mortgage brokers to just about every single one of these buyer's agents. I think I could probably name every single major buyer's agent and a client of ours that have used them, which means we've seen where they're purchasing across the board and it's regular. We do 40 odd deals a month now. We don't work with any buyer's agent specifically, but we see where they're all buying and they're all similar to each other. So if we know all of this, can't we just be like, what will they think in the year 2025? What will they think in the year 2026? Their models for success aren't going to change. Their models for purchasing aren't going to change. They want to be buying areas with decent yields, with rental increases that are happening. They're going to be buying certain types of properties and they're going to be following the data. Once that data begins to turn, you have a herd. You have a stampede.
A stampede.
A Lion King type event is happening. Everyone is running as fast as they can into that area. Run. And then you have these major people who want to come up with all their marketing posts saying that the area is doing really, really well. Not that they've done really well at this point when they've bought. They want to say that they've done well in a year's time. So they keep buying and adding in that stampede of demand. And prices are up 20, 30, 40, 50, 60% from that investor demand that the new demand that's
Yep.
there. And yes, some of this would have happened naturally because they're focusing on lead data of early adopter areas that are going to do well. But what this change means is price growth in certain areas is going to be sharper.
Yes.
Like the demand profile means that rising prices in these areas, the charts are going to look a bit different to the past. In the past, you may have had some investors go in here. You may have had the owner-occupiers come in here because the economy is doing better, activity is doing better. And yes, prices will grow as a result.
Things happen slower though. Yeah, compared to now.
But now you have this huge stampede of investors who are out there being like, where's the data, where's the data, where's the data, where's the data? Find the data. Yes, let's go in here. And they all come slowly one after each other. And it's a wave of people. It's a wave of Sydney-siders who never have ever looked in Townsville and now all looking there, for example. That's new. So the price change should be sharper, which creates an amazingly fun opportunity. Like, it's like, oh, this is fun. You can be like, where are they going to think in the year 2026? Yeah. I don't think that is that hard to predict. I actually think it's a little bit easier.
And if you can be an early adopter, then you should see faster price growth, because if you slightly beat the herd in, they are going to, regardless of the fundamentals of the suburb, they are kind of do the heavy lifting for you, which then also brings about a debate about whether or not it's a long-term hold kind of strategy.
Yeah, well,
but yeah.
Do you think, let's throw a little suggestion. Like, I think we're going to be doing this podcast. I love doing it. It's a lot of fun. We've just hit 100,000 downloads. Thank you so much. That's pretty freaking amazing. I never thought we'd get that many listeners when we first started this. If we're doing this podcast in 2026, like, I'm going to pick an area. At some point, they're going to look at Melbourne and being like, oh, it's so easy to sell Melbourne to everyone. Like,
yeah.
I want to buy in Melbourne. Like, I'm like, I don't own any property in Melbourne. Never owned property in Melbourne, but I'm like, can I own a property in Melbourne one day? It's just got this beautiful aura to it that it's just like, people want to buy in Melbourne. Much, much easier to sell Melbourne to someone than Townsville, for example.
Yeah, of course.
Like, where's Townsville? I don't know. I've never been to Townsville. Go to Melbourne 2 or 3 times a year just for fun. Townsville a bit far away. So Melbourne is exhibiting all of the factors that will lead to that stampede. So I say this in the sense that it hasn't had price growth for a little bit of time. They need that. They want an area that hasn't done well. It has a yield that is now rising because rental prices have gone up a lot.
But prices haven't.
But prices haven't. Prices are moving backwards. They fell again in the latest month. They've fallen pretty much all year. Rents rising, prices moving backwards. If the vacancy rate keeps going low, and whenever the Melbourne economy turns, yes, it is doing quite poorly. Yes, it is interest rate sensitive. It is not doing great. And that may continue for a period of time. So I'm not saying invest in Melbourne now. I'm just saying it's a one to watch that when this happens, you may see a little bit of a stampede there. Melbourne isn't the best example though, because
it's a bit big.
big.
Sample size
really,
is
really
too
big.
high to manipulate the data that much.
Yes.
Yeah.
But Melbourne has 3 sub-regional cities right next to it. And those 3 sub-regional cities are going to have the spillover Melbourne demand there and have their own sort of demand factors in there. So those are ones to watch.
Yeah.
Then there's like other areas. You just got to rule out all the areas that have done really, really well. So you need to look at the areas that haven't done.
Yeah,
that kind of suck.
Yeah.
Be like, Tassie did really, really well, but it'll have its time in the sun again. Sub-regional New South Wales areas, basically, we're talking about regions here, being like regional property investing could be the way to now look at and your opportunity, this is such a crazy opportunity. The opportunity that you are buying is you are buying the fact that sheep will follow each other. The sheep are at scale. The sheep are bigger than ever, and the sheep believe it more than ever. That's the opportunity. You're buying something where it's just like, there's a herd out there that follow each other everywhere they go.
Yeah.
And they run hard. You just need to work out where the sheep are going to go.
Kind of, yeah. So
does that sound a bit crazy? I mean that with all respect to these type of property investors, because I think it's a really, really good property investing strategy. I just mean that the word sheep is more in the sense that there is so many of you now that the scale of this is so large and the structure in which they're buying is so large. It is a good characterization. It's a good investing characterization of it. The herd mentality. It is now the herd. The data-driven property investing strategy is the herd.
Yeah.
That's the new thing.
Well,
so where are they going to look next? Is that the new thing to the new thing?
Pretty much, because I would kind of say, we talk a bit about, rezoning. Todd, in Sydney. So one way of investing is like, all right, you're buying a site that will be, rezoned or have the potential to be rezoned. So like that's one way to like make your alpha return. Like I would say if you're able to pick a postcode that is going to arrive in the top 5 of these DSR tools in the next year, like that's essentially doing the same thing.
Yes.
Basically, where you're being like, all right, like the result of being at the top of these DSR tools now is a flood of demand, basically, because there's now a direct link to what this data spits out and where investors are putting their money, whether it's themselves or through agents on their behalf, right? So yeah, if you're slightly in front of that and you're like, cool, I'm going to pick Bendigo, or I'm going to pick a suburb or a town, and my gut feel or my hope is that this is going to shoot up the DSR numbers and arrive near the top at some point in 25, 26. If you get that right, then you're going to see huge uplift basically because, yeah, the demand follows these metrics now much, much more so than any time in the past where it was a lot more disaggregated.
Yep, exactly. So this is a really, really interesting sort of episode. So now with all of this in mind, the thing to do here is to try and think about what areas are going to top the demand and supply ratios in the year 2026. That is the question of where to buy. And if you can answer that question properly and get that right, you're going to do really, really well. You might not do well in the next year, but over a 3-year time period, you're going to do exceptionally well because when it comes bigger than ever. And that is the point of this episode. The sheer scale, the sheer size, and the nature
the wave
of this.
Of capital that comes in and washes over, particularly if it's a smaller regional area.
It's so different, yeah.
Yeah, the wave comes in. And then I think the added question on the end of this, if you're an investor, is to be like, okay, if this is the way that a lot of, there's, now maybe billions and billions of dollars of capital that's being allocated this way that previously wasn't being allocated this way, what does that mean for a long-term buy and hold strategy? Does that mean the best strategy now has moved to, hey, if you can predict this a little bit early, you can ride the wave to the top and then liquidate, sell out to one of these investors that's coming in on the back end and take your profit versus having a view of the long-term fundamentals of a particular place to be like, that's actually not the investing criteria anymore. The idea is you just want to be in before it's at the top of the DSR tools and out while it's still at the top of the DSR tools and then rinse and repeat.
Yes. I think you talked about something there. If you are investing in these sort of approaches, I think exiting becomes attractive because this is pretty repeatable type formula. And once the investment activity has gone from these areas, it will turn. Vacancy rates will start going up because there's more investors going in there. Rents will start coming down. The economy won't perform as strongly. It'll cycle, basically. That happens. Maybe you want to get out because you would have made your return. Now you can put that return into the next area that does really, really well. In this episode, I probably want to give a shout out to many of PK clients because we work with many of them and they have this sort of approach, trying to be one step ahead of the game in terms of where they're looking at and using the data and understanding that this is the framework that's there. I think one of these concepts may have come from a conversation we had with one of our mutual clients there that spoke about this effect and how it is real and how they're trying to manage it by being one step ahead of the game. And that is part of it. So giving some context as to how to find these areas, you're always looking for economic change. So anything that drives economic change in an area going forward, so anything that drives incomes up, unemployment down, or economic activity up is going to start the chain for everything in that demand and supply ratio. That's the starting point. So you want the best lead indicator, you want economic change. Hobart went through its boom because the Tasmanian economy started doing really, really poorly. Melbourne is doing really poorly in house prices because the state economy, and more specifically the Melbourne economy, the gross state product there, employment prospects, income growth, doing quite poorly. Perth, really, really good example, absolutely on a tear economically. That GST deal has flooded the state with coffers there. The population growth has increased, but population growth increases because the economy is doing really well and they need to bring in jobs. They bring in jobs. They need people to fill those jobs, so they go and get those people. So population growth, it all circles back down to the pillars of economic change that will drive that state to do really, really well. And that's exactly what we're going to talk about in our next episode. We're going to go through where to buy and what states are doing really well. We did this a little while ago. We're going to do a refresher of the state-by-state analysis and see which states are doing really, really well over the period ahead, and try and make a forecast to this 2026 figure that we just mentioned, being like, what is going to do well in 2026? What economic change is going to happen between now and then in certain areas? And what's the data suggesting? So a little bit of an interesting episode. I mean this to all the buyers agents listening, to everyone who listens. I definitely don't mean to cop slack here. I absolutely think what you are doing and the skills that you have are amazing. The buy and hold strategies has elevated the game so much from, just buy near the beach and, buy blue chip properties. It's far
By the street next to you kind of thing.
or the street next to you. The quality of information, the quality of financial choices people are making are so much better because of the rise of these industries, and this data-driven approach has created so many wonderful opportunities. And the clients that you serve are doing exceptionally well, which is really the key point in terms of service, in terms of the product they're buying, the purchases they're buying. It's just the sheer scale and size and the success that they've had, rightly so, has created a new opportunity. The scale has created an opportunity. The scale of success, the success of buyers agents has created the next opportunity on how to take advantage of the success of buyers agents. That's exactly what this is going to be. So perhaps that will be the title of this podcast.